Global market dynamics reflect lingering uncertainty. Wall Street stocks ended sharply lower on Tuesday, with the S&P 500 snapping its 5-day win streak as new U.S. coronavirus cases rose further. Fed's Mester noted that more fiscal stimulus is needed to help the economy recover fully from the crisis amid a resurgence in coronavirus cases. Meanwhile, San Francisco Fed President Daly said the U.S. unemployment rate underestimates the economic damage of the virus, and Richmond Fed President Barkin said the central bank still has more to do with the jobless rate at 11.1%. As a result, the Dow Jones Industrial Average tumbled 1.5%, the S&P 500 index shed 1.1%, while the Nasdaq Composite Index fell 0.9%. Shares were mixed in Asia on Wednesday amid the persistent uncertainty over the pandemic and after European Union executive arm said this year's recession, caused by the coronavirus pandemic, will be deeper than forecast. Japan's benchmark Nikkei 225 dropped 0.75%, Australia's S&P ASX 200 dipped 0.4%, and South Korea's Kospi shed 0.1%. Hong Kong's Hang Seng Index reversed early losses, gaining 0.4%, while the Shanghai Composite added 0.6%. European stocks traded lower on Wednesday with a surge in coronavirus cases in the U.S. and other countries continuing to weigh on investor appetite. According to Johns Hopkins University data, there were almost 11.8 million COVID-19 cases globally as of July 8th. Elsewhere, ECB President Christine Lagarde signaled that the central bank may keep policy unchanged for some time after it almost doubled the size of its pandemic purchase program to €1.35 trillion last month. In individual stocks, HSBC shares dipped over 4% amid reports that advisors for President Donald Trump may try to punish Hong Kong banks by undermining the Hong Kong dollar peg. Shares of Electrolux jumped over 5% after the home appliance manufacturer said that will report a smaller than expected second quarter loss for 2020, driven successful cost cuts and organic sales growth. As such, the Stoxx Europe 600 index fell 0.3%, the German DAX 30 fell 0.2%, the French CAC 40 index dropped 0.4%, and the FTSE 100 index eased 0.2%. U.S. equities rose on Wednesday despite the coronavirus cases hitting a single-day record of 60,000 on Tuesday, bringing the total confirmed cases in the country to 3 million. Several states have had to pull back or postpone reopening efforts to control surging COVID-19 cases, threatening the speed of the economic recovery in the country. Still, the tech-heavy Nasdaq scored an all-time high record after a brief pause. The index gained 1.4%, and the Dow Jones Industrial Average rose 0.7%, and the S&P 500 climbed 0.8%. Meanwhile, the dollar turned lower following earlier gains as investor sentiment improved on Wall Street and thus capped safe haven demand for the greenback. Against this backdrop, the Euro-USD climbed back to the 1.1350 area and extended gains to nearly one-month highs around 1.1370 during the early trading on Thursday. It looks like the common currency will continue its ascent as the creation of an EU recovery fund should support the euro while dollar weakness could be expected, considering concerns about the expanding Fed balance sheet and rising U.S. government debt. Elsewhere, oil prices were relatively unchanged on Wednesday and barely reacted to the EIA report. According to the official data, crude oil inventories in the United States jumped by 5.7 million barrels in the week to July 3rd, but gasoline inventories drew down. Oil inventories remain above the 5-year average for this time of year. Nevertheless, Brent crude rose marginally yesterday and finished above the $43 handle, holding this level above on Thursday. Meanwhile, gold prices rallied to fresh multi-year highs yesterday. The bullion exceeded the $1,800 handle for the first time since November 2011 and rallied to $1,818 amid the recent pickup in safe haven demand. Although risk sentiment has improved since then, the yellow metal retains a bullish tone early on Thursday. That is all for today. Thank you for watching. Please click subscribe to always be in touch with the latest market news.